Thanks, bye.
Okay, that was good. Any thoughts or comments or whatever, send me them through on what Rob was saying. That'd be really good. I'm going to try and stick to time tonight. I'm running slightly over. I've seen Sam join, so welcome, Sam.
Hi, Chris. You all right?
Yes, very, very good. Thank you very much. We always look forward to your slot.
Yeah, I look forward to coming on. I have to warn in advance. I do have to pretty much stick to the time because Mrs. Norris, not the cat from Harry Potter, my wife, she's got dinner ready, and she basically said that she'll have the divorce papers ready if I go over tonight. So I've got to stick to probably 8:44 just to be on the safe side, if that's all right.
We don't want you getting into any trouble, Sam. So that's fine. You're very welcome. We always appreciate the time you spend with us. Cool. Have you got slides to share?
I do indeed. If you want to give me the access to do that, I can do that. I think you have to come off yours first, Chris.
Oh yeah, okay, yeah, of course I do. Thank you. We'll get this right one day.
Soon we'll be back to normal meetings, so you don't have to worry.
Well, yeah, that's true. You should be okay now, cool. Sam.
Good stuff. So hopefully everyone can see. Thanks very much again, Chris and Lisa, for inviting me to come along. I do love coming and presenting in front of you all, and hopefully soon we will get back to physical meetings, which will be great. But yeah, my name's Sam. If any of you haven't met me before, I'm director at Grand Union Finance. So we basically we're mortgage brokers, but we tend to focus most of our attention on the investor part of the market. So I'd probably say 95% of all of our clients are investors or developers in some way, shape or form. So we kind of think of ourselves as a brokerage plus. We obviously do mortgages, but we focus our attention a lot on bridging development, commercial finance as well, and kind of strategizing with our clients more long term. So if you want to follow me on any of my social media, that's how you would do it. There's also my email address, a phone number on there as well, if anyone has any questions. But let's get straight into it. Start with just running through what I want to chat through today. Start off with some mortgage news, all pretty positive, which is good. Then on to some bridging and development news. And then last month, if you remember, I did promise that I would run through what I recommend my clients put into their valuation packs for refinancing. So I'm going to run through that, and then hopefully we'll have some time at the end to have a few questions as well. So I will kick things off with mortgages. So well, I think we've all been kind of overwhelmed in the last month or so with, being told that we have a seller's market, that the market's really buoyant. Everyone's waiting for this ominous crash to occur. The mortgage market is very, very busy. That has been highlighted literally yesterday. A message came out from Halifax /BM Solutions, because they're both run by the same people, effectively saying to brokers, please don't call us, we're too busy. That hasn't happened in a long time, and especially a lender like Halifax, they're one of the go-to residential lenders. They have got capacity. We're not talking some small fry here. We're talking a big bank. So for them to put a plea out just shows how busy we all are with applications. So that's a really good sign. It's only going to be a good sign for the market. Now, for those that didn't see, the Bank of England held its base rate at 0.1 today. Now, one of the things that I picked up on this, which is quite relevant from the mortgage perspective, is they felt as though they couldn't increase the rate at all because the lenders, banks, were still working a certain margin in because of what they deem to be a higher kind of lender risk, higher borrower risk at the moment, given everything that's going on, and because they're losing money, so they're having to increase their margins to still ensure that they at least try and hit something that resembles their annual targets, because of course those targets are there for a reason. They've got people to pay, they don't want to be losing staff, etc. So the Bank of England have kind of accepted this. But one of the other things that came out on the flip side is there's been a lot of chat about negative interest rates coming along. And what we're hearing is, although they know that they have this as an option, they have no immediate plans to act on that. So for me, that suggests that after the next sort of couple of weeks, once the news of the, that it's not moving and it's probably not going to move for a while settles in, we're actually going to see some stability in rates probably for the rest of the year. But what we are seeing is that as a result, even in the last couple of weeks, lenders are tending to increase their rates, especially at the higher loan to values. We're seeing that higher loan to values come back, which is good. But unfortunately, we're seeing them come back with higher interest rates. Just as an example, because I thought this was quite astonishing, Barclays increased their product transfer rate. So basically what that means is if you have an existing bank mortgage with Barclays, you come to the end of your fixed rate and you get in contact with them to just to sort of move on to another mortgage with them. Usually those rates are pretty much resemble the rates that you would get if you were a new borrower, but they've actually put them up by 48 bips, which is, that's quite a lot in one foul swoop. So not necessarily good news for the higher LTV products, but at least we've got a buoyant market at the moment. So that's something. Talking of high LTVs, this is one for the buy-to-let investors. Foundation, who were actually, to be honest with you, and I don't sort of favour lenders over any other for sort of products or anything like that, but Foundation over the last couple of years have been, for me, a real kind of stable lender. What they tell you they're going to do, they tend to do, which is quite nice when you have to deal with the likes of the Paragons and the Shawbrooks of this world that do the complete opposite. So it's nice to see that they're coming back into the market with a vengeance. On the last meeting, I spoke about them coming back in with their serviced accommodation products. They've now brought back their 80% loan to value buy-to-let products. Now, I do not recommend that anyone leverages themselves above 75%. I just don't think that's a good risk to take. The reason that why any of my clients will go above that is when there is a decent reason. An example of that would be recently we had a client that we needed to refinance. They had a slight down valuation and they really desperately needed to get the cash out quickly to repay an investor. So we actually went to 80% on that deal. But the conversation that we had beforehand was that they were going to be putting cash aside from the income from that property, which was an HMO, and they were going to make a lump sum repayment after 2 years. When we came to refinance that deal, we stuck in for 2 years so that we could do that and bring it back down to 75%, even if there was no increase in value of the property. So top tip there, try not to over leverage yourself because it can bite you in the arse, especially in times like these. On that particular product, which is really, really good, is like many 5-year fixed rates, if you're worried about the rental calculations being quite tricky, especially if you're trying to get 80%, they will actually work that out on the pay rate. What that means is they're not stress testing the rental calculation at 5, 5.5 or 6%. They're actually doing it at the pay rate. That particular product is at 4.79. Sounds toppy, but it's a lot less than 6% when you're stress testing. So if it's something you have to do, I'm here to tell you that these products are coming back into the market. So it's showing lender confidence in the market, which is positive. What isn't so positive is we are getting some news now that some of the bigger lenders are seeing some really, really big losses. Bank of Ireland and Metro in particular came out over the last couple of weeks to inform their shareholders that they were seeing some pretty negative stuff. Metro have actually, on the back of that, said that their plans for the next 2 or 3 years in terms of their strategy for borrowing has changed, and they're really going to push into the more specialist market, which actually is quite good for us investors because it means hopefully we've got now another big powerhouse like Metro. And Metro are a great bank to work with. So if they're going to be starting to push into the more specialist market, it probably means that they're looking for margins. That's what they're looking for because they know that they can get away with that. But if they're looking at their commercial side and their buy-to-let side, that possibly could be good to add a bit of competition to the market in that sector. So on the whole, good news mortgage-wise, with a little bit of a negative bit just to finish off there. Bridging and development news, not quite as positive, I have to admit. the mortgage market has really bounced back from COVID quite nicely, in my opinion. And actually, I know banks get, hammered constantly, especially in the media. Conversations that I've been having with some pretty high up people at a lot of big banks, I'm pretty impressed with the way that they've handled this, to be quite honest. Of course, they've got to look after themselves. Of course, they've got to look after their staff. But actually, they're being pretty fair. They're not going too toppy on rates. And it's been pretty good. They're coming back and they're offering the products that we need for the market to be, as buoyant as it is. Bridging development, as I said, not quite there just yet. In fact, in the last month, I've applied for the highest bridging loan in terms of rate that I've ever done in 13 years of doing this, which was at 1.45%. Now, I must admit, when I was having a little bit of palpitations when I was going to tell the client that this was the best thing that was on offer for him. And it was actually quite nice, his response, because we went through the figures and the deal still made sense. And I've always said, as long as the back end looks okay in terms of maybe a refinance out, because a lot of the time you take out bridging and you need to refinance it or sell the property. With this, we had a really strong exit strategy. We had a good potential mortgage, or we actually had a plan B, C, and D in terms of mortgage lenders that were going to be at good rates. He could still recycle quite a lot of his cash. And so in reality, that 1.45 didn't mean a lot. Yes, it would have been greater if it was sub 1%, like we were used to pre-COVID, but the deal still made sense. So we went ahead and we did it, which was pretty cool. But that just shows you where that was. That was at 75% loan to value. Now, it's quite difficult to get 75% loan to value on a bridge at the moment. Most lenders have sort of kept themselves to that sort of 60 to 70% kind of margin. And a lot of the better lenders were sticking to that pre-COVID anyway. 60 to 70% on a bridge was relatively normal. If you needed to go to 75%, those lenders were there, but it did, make the market a little bit smaller for you. The market has shrunk even further basically now, and you are having to see these much higher interest rates if you are getting to 75%. If you're not, and you can stomach 60 to 70, and I genuinely, this is weird coming from a mortgage broker, we get paid on how much we borrow, but the lower you can leverage, the more skin you can put in the game. Basically, when you're on your purchase, the less you can borrow on a bridge is always going to be favourable, because number one, the interest rates are going to be less, but obviously you're borrowing less overall, and so your cost of funds will be lower, your return on investment will be higher. It's pretty much as simple as that. But if you can get down to 60, 70%, we're looking at probably 0.7 to 0.8% per month as the typical kind of rates that we're looking at the moment. So if we achieve that, we're doing okay. So don't be sort of thinking that we can get the sub 0.5% kind of rates that we were looking at pre-COVID. They just don't exist at the moment, unfortunately. They will come back, I've no doubt, but probably not for the remainder of this year, I wouldn't have thought. Talking of lenders coming back, there are still some big players still not around. Together really haven't opened the doors just yet. And they've actually announced in the last couple of weeks that they could potentially be getting rid of over 2/3 of their workforce. Whatever your opinion of Together is, they've provided the market with lending for a long period of time. Whatever they're doing, they're suffering for it at the moment. So whether they've overstretched themselves, who knows? But with big players like Together still not really fully back into the market, of course, the competition isn't as rife as it was. And competition is what drives up loan to values and what drives down interest rates. So without that, we're not going to see too many changes, I don't think, over the coming months. So as lenders start coming back into the market, hopefully that competition will improve. Now, some good news this time to finish up on in terms of the news here is that Mint have announced within the last month that they're actually increasing their loan to GDV on development finance back up to 65%. Now, for those of you that think I've just been speaking a different language for a few seconds there, loan to GDV is pretty similar to a sort of a loan to value that we look at on a standard mortgage or a bridge. It's the loan based on what the GDV of a development project will be. So 65%, if the GDV was going to be 1 million, the max loan would be 650,000. And how the lenders split that up is they would look at a maximum amount based on the purchase price to contribute towards the acquisition of the site. and then whatever remains of that 65% of the GDV can contribute towards the works. Now, that might mean that you can actually cover 100% of the works, but obviously the higher the loan to GDV that lenders will go to, the more chance you've got of getting to a relatively high loan to value on your acquisition and be able to cover a large percentage, if not 100%, of the works as well, meaning you need to put less money into the deal. Now, I know that kind of goes back on what I just said before, but when it comes to development finance, I know a lot of my clients prefer to put less in, so they hold money back to look at other opportunities. So this is pretty good news. Again, whenever loan to values go up and interest rates come down, it is a clear sign that the market is recovering, or that lenders are just becoming a little bit more comfortable with how things are. Mint are a pretty good lender, to be quite honest with you, and they'll even lend development finance to brand new developers for the right broker, I've been told. So if you don't even have any experience of development, a lender like Mint can still be an option, which is good. Now, oh yeah, sorry, I forgot one more thing to talk about in terms of sort of the development and bridging news. Some of you, any of you that do follow me on Instagram will be seeing that I've been talking about this a little bit over the last month, which is the kind of bridges based on open market value. We've been seeing a little bit of an increase on this recently, and it is a strategy that can help you if you don't have the cash reserves available, so you don't have to, say, go and stack a deal with some crowdfunding or go and find an angel investor. It means that actually lenders can base their loan on the open market value, and this can work in two separate ways for you. The first is that it just means that you need to put less in day one. If you're, say, for example, you're buying a property that's the open market value is 100,000 and you're buying it for 75, there are lenders out there that will lend you 75,000. So day one, that can potentially help you out. But where I've used this in the past is with a sort of a delayed completion scenario. So whereby you might agree to buy a property from a vendor, gain access to the property to complete any refurbishment work, and then complete based on a kind of a lower amount. But obviously what you've done in the meantime is you've brought the value of the property up. Now, what we can do with these types of bridges is we can delay the valuation. We can get an offer based on a predicted, well, I suppose you would call it a GDV, but an open market value once the work has been done. And then we send the valuer out once you've completed the work. You then complete the purchase based on your original, purchase price, but you get your bridge based on what the value is once you've completed that work. And sometimes, again, that can mean 100% of the purchase price covered. Now, I don't recommend this really if you're following a kind of a buy, refurbish, refinance model, because often you're not going to be getting money back out of that deal because just the numbers aren't going to quite fit. But it's a really, really good type of financial arrangement to look at if you're going to flip a property, for example, because basically it just means you're buying the property, potentially even covering the cost of some work, and then you're just selling it on, and it's just profit in the bank. So if you don't have a lot of cash in the coffers, something like that could work. And we're seeing a few more lenders coming around to this. There's only a few that will go up to 100% of the purchase price, but certainly more and more that can base the loan on the open market value, and then they might limit the loan to value on the purchase to maybe 85% or 90%. Some will go to 100, but they'll be basing it on the open market value. So a little trick that some bridges can do, which is really, really cool. Now, and I'll take a deep breath because I just spoke really quickly for a long period of time. Moving on to what I was talking about last month in terms of valuations. Now, I probably get questions about valuations more than anything else at the moment, because obviously it's quite a contentious issue. We're being told that the market's buoyant, but the contradiction is that the lenders, valuers are going out and not necessarily giving us the value that we're anticipating. And I think the disparity really is that we've got a lot of agents out there at the moment telling everyone that the market is incredible, and they're saying, Mr. Smith, you want to sell your house for 400,000 because Mr. and Mrs. Jones across the road have their property on the market for 410. Well, it doesn't quite work like that when it comes to mortgage valuations. They don't look at what's going to happen moving forward. They look at what has happened. So predicting the market is what agents do. Surveyors don't. They work on cold, hard facts and what has actually sold. So at the moment, I've always been an advocate of creating a valuation pack, specifically if you follow that model of buying property to renovate and then refinance. You want to show the surveyor that actually the property, once it's been completed in terms of the refurbishment, is going to be worth what you are expecting it to be worth. You've got to prove that. If you can't prove it, no valuer is going to stick their neck out for you. But this is how we do it, and we've had a ton of success doing this over the last couple of years, which is to create a valuation pack. Now, first page, just like anything, you need a covering letter, basically. And what we put on this covering letter, or project overview, as we call it, is essentially the basics of the deal. Things like the address, purchase price, refurbishment cost, basic overview of the kind of works that you did. I converted this 3-bedroom family home into a 5-bedroom HMO. We renovated this 3-bedroom family home, converted into a 4-bedroom with a double extension, blah, blah, blah. You get my drift, basically. You give a bit of an overview. And then, of course, you look at it on the back end, what you think that the end value is going to be. And if you're renting it, what you believe the rental income is going to be as well. So just a bit of an overview for the valuer to get a feel for it. Next thing we want to include is a schedule of works. Now, often we'll have these available anyway, because when we go in for the initial funding, even if you're just getting a bridge and you're covering the works yourself, a lender's going to want to know that A, you've got the money to do it, and then proof that that's going to cover it by way of an official schedule of works. Now, I'm a great believer that you want to have this as fleshed out as you possibly can. You want to pretty much week by week have a list of the work that is going to be done and a running cost of what that's going to be. If your contractor or builder can't do this, if I'm completely honest, I would probably have maybe a bit of a second thought as to whether they're going to be the right builder for you. This should be bread and butter. My dad's a builder, so I'm a decent authority on the subject. I spent many a Sunday wanting to go and play rugby with him down the park, and he's been sitting there writing these bloody things out. So yeah, I know firsthand that they do them. So, and just to add that bit of professionalism to them, you make sure that it's on their headed paper. Just make sure it looks tidy. But that's what we have as our second page. So straight away the surveyor's gone, okay, I'm getting to grips with the idea of what's gone on, and now I can see that they have actually done the work. It's all listed out, and I can take a little bit more of a deep dive into that. Now, the next one, probably, and these increase in levels of importance as we're going through, before and after photos. Remember, the valuer is going to go into this property and he's going to see what it looks like now. Of course he is, but unless he can physically see the difference in what you've done, yeah, you've got a list of the works, but he doesn't know what an absolute, dire, horrible state the property was in when you bought it. And a real sort of top tip here that I find, and actually a client taught me this, which I thought was fantastic, not that long ago, literally about 9 months ago. He arranged his photos, before and after photos. He took them from the same position in the room, and then he put them next to each other. So I mean, it was about 4 or 5 pages of these photos, but it was, dining room from the back before, dining room from the back after, and he put them next to each other as you go down. Made it really, really easy for the surveyor to have literally a direct comparison. So seems really obvious when you say it, but it's amazing how many times I get sent basically about 100 photos, and then I have to kind of play jigsaw puzzle and fit them all together. I'll be honest with you, a lot of the time I just send it back to the client and say, can you just put these in order for me, please? But yeah, that for me is the perfect way of doing it. And of course, the last part is the most important, and that is sales comparables. You can have a great 1, 2, and 3 on here in terms of the sections. If number 4 doesn't stack up, surveyor's not going to be interested. As I said before, don't base what you think the valuation is going to be on what an estate agent tells you it could potentially sell for, because it's just potentially. If something's on the market elsewhere for a certain amount of money, it makes no difference because it hasn't actually sold yet. So we need cold, hard facts, as I said before. Generally, we only look back about 3 months. We want something in the relatively, reasonable vicinity of your property, and something that is actually similar in terms of the aesthetic and the square footage if we can. I know not always it's easy to get that kind of detail, but the better we do, the more chance we've got of supporting this. And also, don't do what one of my clients did literally last week. Send me sales comparables of 3 properties that sold 10 grand under what he wanted the valuation to be, because a surveyor is going to look at that and value it 10 grand under, because that is what you're telling him. The information you're giving him is telling him that. So they are the 4 sections you need to have in a valuation pack. Seems like a lot of work, but trust me, it's worth it. And if you ever thought that getting into property meant that you weren't going to have to put together these sorts of things, then you've been on the wrong course. So it's time well worth spending, 100%. But yeah, I think we've got a bit of time, about sort of 10 minutes maybe or so, for a few questions. So yeah, if anyone's got any, then feel free to chuck them in my direction.
Thanks, Sam. That was great. Yeah, there's a lot of content. There's a lot of content. I always know there's a lot of content because the amount of copious notes I make as I'm going through. So
I always know how much content there is, how much I sweat during the presentation.
I thought you were speeding up as well. So that's good. I'll just open it up to everyone to see what questions there are.
No one.
I think you might have.
I've got a quick question.
Hi, Lewis.
Yeah, hi, Lewis.
Mate. Back from when I texted you recently, I just wondered if there's been any more development on the HMO mortgage side of that. Is there any chance of it changing, or are we still looking at quite high rates for limited company HMO mortgages?
Yeah, the HMOs are always going to be a little bit higher than buy-to-let mortgages, because they're a little bit more. They're seen by lenders as higher risk, basically. The good news is that as lender confidence grows, that goes across the market. That's not just going to be limited to buy-to-let. So yes, we can get 80% on HMOs now. Like I said before, wouldn't necessarily recommend it. And realistically, where rates are at the moment with HMOs, which is probably about maybe 0.2 to 3% higher on average than your standard buy-to-let, limited company buy-to-let mortgages. I can't see that changing really over the coming months. If anything, at the higher interest rates, they might even go up a little bit as lenders try and recoup their margins. Because the thing is, any lender, it's a business thing in general. If you're really, really busy and your capacity is, I don't know, for me, it might be dealing with 20 clients a month, for example, and I'm charging £1,000 per client. That's not how it works, but just to make it easier. If I'm suddenly inundated, one way of keeping myself the same level of busy and making more money is to up my rates. And that's exactly what the banks will do. If they continue to be as busy as they are, potentially that is an impetus for them to actually increase their rates, because they're still trying to, recoup losses from earlier on in the year. So to answer your question, Lewis, I think HMO mortgages are pretty much where they are. I can't see them coming down. The good thing is, I think if anything, we might just see a little bit more of a relaxing of criteria based on experience and that sort of stuff.
Sam, thank you very much. You're always a wealth of knowledge. Appreciate it, mate. So,
cheers, Lewis.
Thank you very much.
Thanks.
Yeah, thanks, Lewis. I've got some questions of my own, Sam, but anybody else?
Yeah, I'd like to ask a question. Hi, Sam. How are you doing?
Oliver.
Hello. So we keep hearing that in a few months' time, when furlough ends and stuff and all of that stuff disappears, the market is going to implode. Are you seeing banks changing? What are banks doing to hedge against it? Or do they know something we don't know, i.e. the market is not going to implode and we should just carry on as normal?
Yeah, see, I've got a bit of a controversial thought on this, in that, I mean, and maybe because I'm seeing it firsthand. My wife's been furloughed since March, literally driving me nuts. And so I've seen her be pushed back. You know, she was meant to go back to work at the beginning of last month. That got pushed back to this month, got pushed back to the 14th. It's been pushed back again. When she goes back, they might even be taking advantage of like the part-time furlough system that's been brought in. So I'm seeing it firsthand. And my, you know, I'm not necessarily reading this anywhere, but I'm kind of coming to my own conclusions on this, that are, if, you know, a lot of the economic issues that are being predicted seem to be in line with what's going to happen with unemployment rates. Now, I still think we may well get to the same level of total numbers of unemployed. But with the extension of the furlough and with the bringing in of the part-time furlough scheme, we could see that this amount of people spreads over a longer period of time. And because of that, the impact may well not be as high as first expected, because we won't get maybe like a spike of people just suddenly becoming unemployed. I might be wrong. But me just looking at this information and coming up with this myself is I'm thinking, okay, well, you know, if we're going to get just plucking a figure out the air, 5 million people become unemployed. But when we were thinking about it before, that might happen over the course of 2 months. If that happens now over the course of 4 or 5 months, that can have a big impact in terms of how negative an effect it can have on the economy, because it spreads that. Also, there are a lot of businesses that have done really, really well during COVID, and they're employing. I am currently hiring, right? I started my business 2 months ago. I'm already looking for somebody. So people are, you know, businesses have done well, and those people will hopefully be picking up the staff that are maybe being laid off elsewhere. So I know that there's a lot of doom and gloom around. But maybe, look, I'm always a glass half full kind of guy. My wife tells me off for being that. She says I'm too bloody positive for my own good. But yeah, maybe it's not going to be as bad as we first thought. Plus, you know, it was only a matter of weeks ago that Knight Frank, who, you know, one of the biggest, most prestigious surveying companies in the country, actually changed their prediction that the property market would only reduce by 3.8%. That's nothing. That is absolutely nothing on the grand scheme of things. 10% isn't actually that big when you think about it compared to some of the crashes that we've had in the past. So if we're looking at less than 5% in terms of the market, the property market going down as a whole, that's nationwide, then, you know, is it going to be as bad? Are we going to see a crash? Because I think there's a big difference between the word dip and crash, to be honest with you.
Makes sense. Very good perspective. Thanks.
No worries at all.
I suppose the interesting thing there, Sam, is, you know, what are the lenders actually? What's their view? Are they pricing in, you know, a difficult economic position in, you know, 12 to 18 months? Yeah. What are the longer term rates? Because from my own experience, there doesn't seem to be, you know, that much difference between, say, a 2-year fix and a 5-year fix.
Then do you know what? My experience over the last few years is that there hasn't been, I mean, in the grand scheme of things, there hasn't been that big a difference. And I think when we look at, you know, looking over the next year, 18 months or so, where lenders are maybe starting to worry a little bit is just at the higher loan to values. Now, the thing is that they haven't really, apart from obviously I mentioned Foundation come in, that they're one of a few different lenders that have come back in on the buy to let side at the high, they sort of what I would call higher loan to values, anything above 75%. But on the residential side, where we've got, you know, more of the big players like your Barclays, your Santanders, your Halifaxes, you know, these types of lenders, all we're getting is anything sub 75 is pretty much staying where it is. If it's above 75, we're starting to increase rates. So they are worrying a little bit about the fact that we're going to have a dip, but they're not worried to the extent where they're starting to raise interest rates at the lower end. So I think for me, if we start seeing a massive increase in 75, you know, 65 or 70% kind of rates, then maybe we should be a bit more worried. The fact that the banks are pretty much sticking to their guns on that, and actually, what was it the other day? We did a remortgage for a residential property, one of the few that we do nowadays, at 1.49% on a 5-year fixed. So you know, the lower interest rates, they're fine. It's just the upper interest rates. So I think it's kind of, you can see that as a bit of a sliding scale, that's where they see there being a problem. That's where the risk is coming in.
Mm. Okay, now that's good, Sam. I've got a couple of my own questions. You said that Metro are coming back into the more, the specialist market. Now by specialist, so my take on that would be specialist would be sort of HMO, SA, maybe that sort of market. Is that exactly what you mean? Yeah,
that's it. I mean, look, that's literally all I've had so far is, and that was just me reading through one of their reports and just grabbing hold of that. As you know, I was going through it. A lot of it wasn't particularly relevant for me, let alone, you know, a presentation like this. But yeah, they mentioned about going back into the specialist market. Of course, you know, Metro historically have had a commercial side, but they've always been a real go-to lender for residential mortgages because they've been great with people that are self-employed and on contracts and that kind of stuff. So for them to venture into the specialist market, for many, they might see that as a bit of a strange thing, but they have had they've been a commercial bank for a long, long time. So I don't think that's going to be too much of an issue. I think they're probably, what they're looking at is to rival the likes of a kind of an Interbay or a Shawbrook, where they're kind of mainstream commercial, where they will look at maybe, you know, sui generis HMOs, things like that. Maybe they might even look at yield-based valuations, which would be cool to have another option there.
Yeah. Sorry, did they talk about when they were going to go into the specialist market?
No, they didn't get that far. I think it seemed to me like it was kind of not an afterthought, but it wasn't kind of the main part of their report. It was just this is our plan. You know, stay tuned for more information, basically. But look. I inhabit the specialist market. The more lenders I've got, the better. So I'm happy about that.
Yeah, the more options you've got. Yeah, that's good, Sam. I agree.
I might have to cut you off because I've just noticed it's hit 2044.
Oh, okay. I don't want you get into trouble. So that's great, Sam. As always, we really appreciate the knowledge and your time to come on the call. And if you send your slides, I'll make sure that people can have access to those.
Absolutely. Great. Yeah. Thanks.
No regards to your wife as well.
I will do. And if anyone's got any questions, just send me an email or a message.
Yeah, brilliant.
Cheers, guys.
Right, thanks, Sam. Cheers.